Welcome to the daily update, where I'll go over the action in the market for Friday, September 20th, and then we'll see how things look for Monday, September 23rd. It was quadruple, triple, whatever you want to call it, witching for options expiration, and that really pumped up the volume. And so we saw kind of a slow day as far as price movement as these positions were squaring up with each other. But we really didn't change as far as our technical outlook. We were down a little bit, but we're still positive in the short, intermediate, and long term. But there are some concerns. We have this confirmed Hindenburg omen. We're coming into a time, especially after options expiration, of weak seasonality. Now, that's historical. Doesn't mean it will happen this time, but it certainly can. And so we just want to be aware of those things, even though things are looking quite positive. The Dow set another new all-time high. The S&P did not, since it ended up closing down a little bit. We're looking good in that aspect. So there's a lot of positive things right now, but there's some things in the background that we need to be aware of. I do have the SPXInvesting Program. It's up, it's running, it's free for right now. I'm going to be locking that down at some point in the next month or two, but you can check it out. There are additional videos that I post there that I don't make public. There's a link below this video that will take you to the website, as well as to a video that talks more about the program. And those of you that are watching this video on Monday, the 23rd, you have access to this as a member on, well, it's Friday night or Saturday morning, right where I'm located. So you get early access to that and the weekly videos that I do and additional videos that I do for the website. So that's just one of the benefits that you get right now. I'm also thinking of doing a live class near the end of October. I'm just going to throw that out there and see if anybody's actually interested. It'll be a basic class, just the basics of the stock market, which is already available on the website, but this will be a live class. So it'll be a pared down version of the overall basic course. The daily video is the real foundation of the analysis that I do. All the other videos around the outside are weekly videos, and those are meant to feed into the daily video. All right, let's go back and talk about what happened. We did have a bit of a lower open. It was pretty much flat, but we went down right after the open. We declined below S1 at 56.89. Then we rebounded. We almost got back up to the daily pivot at 57.11. So down that 5,700 level is in play. And we almost got up to the unchanged level, but not quite. As the day went on, we fell back down to S1. Then we rebounded back up. So it was kind of a roller coaster day. We got to the daily pivot and unchanged level, but we closed slightly below the daily pivot. We were down 0.19%, so not a real big move that way. Volume was way above average because it was options expiration, and we're still positive in the short, intermediate, and long term. Interest rates were up a little bit, and inflation seems to be more under control according to the stock market. Now, remember, there's real life inflation and what you're dealing with on that level, and then there's stock market inflation and what the market is dealing with. And the two are not necessarily related to each other at all times. We want to keep an eye on the geopolitical things that are going on, just in case something escalates that has an impact on the market. The Dow did set another new all-time high. We're wondering, is there this FOMO coming in, the fear of missing out? We had a big update on Thursday. A lot of people may have decided to get in on Friday. They haven't seen much of a change now, but is that going to carry over into the weekend? A lot of people, they do their research and analysis and management of their portfolios over the weekend, and they say, oh, okay, the Fed cut rates. We had a big, strong update. Everything's looking all right. I'm going to go put in some buy orders. That may happen because they're afraid of missing out on these opportunities. And when that starts to happen, that can quite often mean the party is just about over. We do have a confirmed Hindenburg omen right now, and we are coming into this period of weak seasonality. And I'm going to keep harping on that over and over because we do look at our charts. And right now, everything is looking pretty good. There's always some concerns that we need to be aware of, but this can shift. at any time. And we have two kind of negative things just lurking behind the market right now to see if they're actually going to kick in. On a short-term basis, our usual charts, we have one new addition here. The rate of change going back 10 periods is looking extreme, but we have the Stochk RSI, the Williams percent R, the CCI 14 and 20, and the boom indicator. We're still kind of far away from that 20-period moving average. That's really more to do with Thursday's upthrust and the stochastics. In the intermediate term, we still have the CMB composite, the 50-period moving average on the S&P, the Arun, which is kind of acting a little strange right now, the Sean trend meter, and we have the bullish percent index for both the S&P. That had already been extreme. Now we're just on the border of the NASDAQ 100 bullish percent index becoming extreme positive. And then another one that was on the list for a long time dropped off. Now it's back on. It's a 10-day moving average of the new highs, new lows for the S&P. Long term, we have the 150 and 200 period moving averages, both the simple and the exponential moving average. And I have charts to show you all these things. The scenario did change a little bit this past week where the Fed did come in and they cut rates 0.5%. Because it appears that this soft landing scenario seems possible, the fact that we're not going to go into a recession, that could change going forward from here. We can only go with what we see right now. The dollar was up and interest rates were up, not very much. We closed at 3.74% for the 10-year yield from 3.73%. Now, I'm a little bit suspicious of this 3.74%. I looked at 3 different quotes for the 10-year yield and got 3 different answers. So I think that's about where we closed. We're still inverted with the 10 to the 3-month yield curve, where the 10 to the 2 has gone back now to being normal. Sentiment did tick down with the slight down day. We had been at 66. We're now at 63, but that's still positive. And we're trending now because we're above the moving average, but we're not above 20. So it's a non-confirmed trend at this point. With the slight down day, our bias is negative, and we're still positive with the momentum overall. That's the last 2, 3, 4, 5 days taken together. Didn't have any economic reports, so there's no charts to show you there. Here's a look at what's called the 10-year break-even rate. That's looking at inflation down the road and then comparing it with oil prices. And you can see on this chart, there's a pretty strong correlation, especially over the last few years, where if this is inflation is going down, oil's going down. If oil's going down, inflation's going down. So we're just seeing kind of a correlation right here as they both have been declining. And then this, I'm not going to go through all the numbers here. It just says, yes, the Fed has cut near all-time highs and the bulls loved it. That just goes back through history, all the way back to 1980. And what happened? Well, sometimes it's negative going out for the next month. When you look out 3 months, 6 months, and a year later, the returns tend to be pretty good. And the further out you go, the better the probability of it being up is, with 75% 3 months and 6 months out. Then the allocation, it's at 61%. It had been coming down as the market had been under pressure earlier. Now this may start to be going back up if the market keeps going up. And then 50 basis points for the little guy. Not sure really what that means. This is just a historical chart here showing the Fed funds rate going back to 1915 and when we topped out and started coming back down and different events that happened along the way. This is a little bit outdated now because this had to do with Friday's session. These are all the options that are on the books right now. And it just says there's 4.5 trillion in option worth or values at this point that expired on Friday, September 20th. And so that's why we see such huge volume. And sometimes I say that the options expiration day is kind of its own beast because all of this stuff has to be dealt with by the end of the trading day on Friday. That's why with the strategies that we do, we're well out of these September options weeks before we even get to options expiration. We don't want to deal with any of this. We're already going to the next month out with the strategies that I like to implement. Then the first Fed cut of easing cycles have favored growth over value, small over large, and bonds over stocks. This is kind of convoluted to read through this, but just take the headline is kind of the takeaway from this particular chart here, but we want growth to do better. Now, it had a good day on Thursday. It really didn't do much on Friday. We're keeping a close eye on that. That's the buy low, sell high. We want growth to really do well. And I'll be doing more of an analysis of that in the weekly videos. And small caps have typically outperformed large caps in 6 months after the first rate cut, but have underperformed in the initial months and had a mixed performance over 12 months. Okay, so I look at small caps. I don't do small caps. Those aren't the strategies that I do, but we still keep an eye on them, where they tend to underperform at first and then do better later. That's probably because it takes some time for the rate cut to actually get into the system and for small cap companies to actually see that and be able to take advantage of that. And high real rates hurting access to finance. This is just small business access to bank lendings versus jobless claims. And this is why, because most companies in America are small businesses. And if they have to pay more in interest, they're not going to be able to hire new people or even keep some of the people that they have. I didn't spend really any time on Twitter. So not really anything to show you there. Not a big day overall. We did have the big day up on Thursday, but then we ended up going lower down below S1. We found some support, didn't quite make it back up to the daily pivot, and the unchanged level came back down to S2. This did provide some support, came back up to the daily pivot, almost went positive there for a second, and then just drifted down below the daily pivot. And nothing really happening. It was pretty quiet compared to what we saw on Thursday. This pretty much mirrors what happened in the cash session. And we're still a little bit concerned about this. We were a little more positive about this after Thursday, where the blue line and the red line were on top of each other. Now we're seeing value, the red line above the blue line. And the market can still go up in those conditions. But when we see the real power, see where the blue line is well above the red line, at other times when we saw real upward moves, we want the blue line to be above it on the intraday chart. It's not there right now. And not much of a change here with the growth to value ratio for the S&P intraday. Saw a nice little spike up on Thursday, but we need to see this go up. And you can see we topped out back in August, and then that's when the market was under pressure. When the market started to bounce up, growth started to outperform value, and we were going flat. We saw the big up day Thursday, and now we're still going flat for right now. End of day, we had growth down a little bit more than value, where for the mid caps, it was down less, and it was down less for the small caps, but everything was red in Friday's session. So not much of a change here with small cap growth to value. Mid cap growth to value bounced up a little bit. We want to see more of a upward thrust from this, and a little bit of a tick up here with S&P growth to value. But again, we need more follow through with this. A little bit of a bounce up here with the growth versus value ETF. We're still inside of the rainbow. Large cap growth is still holding up down fractionally. What we're a little bit concerned here is the 50-period moving average is going down and could possibly cross below the 100-period moving average. Now, if price stays above these lines, that won't happen. But if we end up coming back down, that could end up happening. And saw a little bit of a bounce here with discretionary to staples, showing a little bit of improvement, but we want to see more follow through here. So we're just barely above the moving average with our ADX. So we are in a trend, but it's not confirmed until we cross back above 20. The green line is on top, even though it declined slightly with the down day. We want the green line to go up. We want the ADX to go up above the moving average for things to stay positive. And we're seeing a little bit more of a turn up here with the short-term chart, but still below 20 itself, although it's still positive. And we saw the massive spike in volume because of options expiration. We're dropping down below the moving average with the Ulcer Index. This is a fear gauge based really around mutual funds because they only have an NAV, which is like a closing value. If we drop down below the moving average, I'll probably stop showing this chart for a while. I really only show it when we get above the moving average. And we tick down a little bit here with the VIX on the line chart as well as the bar chart. And the VIX of the VIX also saw a decline. This fear was coming off a little bit. Even though we had a down day, we didn't see a real pickup in fear. The VIX is still having a momentum of going down based on the MACD, but we're concerned about this. This is historical. This is going up. This means stocks are going down, and the VIX can really go up during this time of year. And now this is the highest rating we've seen with the SKU index. This is a variation on the VIX. where the VIX uses at the money options, the SKU index uses out of the money options to calculate. And this just means the market's expecting a really big move here. And we just keep going up and up and up. And you can see other times when we spiked and then started to come back down. Sometimes that meant a top, sometimes a bottom, sometimes a continuation. So we have to use other charts to give us some context for what could be happening here. And we declined with this fear gauge, where with the other fear gauge, we ticked up slightly. So not real uniform across our fear gauges right now. We did go up a little bit here with the risk on versus risk off. This is like a sentiment gauge. When the market is feeling more positive, they go risk on. When they're more negative, they go risk off. And we saw a real big decline with the equity put call ratio on the daily chart, enough to just barely tick the 5-day back down. After it had become extreme, was starting to go up. That's negative. The fact that this is rolling over might be seen as positive, but again, Friday was its own day, so we'll have to see how that plays out. We're still going down with the 10-day equity put call chart, and we're dropping below the range here with the volatility risk premium, as there's not a lot of fear right now. And the advanced decline line holding up. It did tick down based on price and volume, but we're above the advancing moving averages. We're seeing more new highs than new lows, even though they're dropping off. It's still helping our 5-period and our 10-period average to go up. And here's the big spike in volume here. With the accumulation distribution, we're positive now, and we did turn back up, and that's good. We're a little bit extreme as we're getting kind of far away from that moving average. Now, this has been a concern lately because before Friday, even though we were going up with the S&P, this was starting to come down. And that was a bit of a concern to us. It's looking better right now, but we'll be keeping an eye on this. We're declining a little bit here with our advanced decline ratio, but still positive. So we break that out based on price and volume. It's also still positive. And this was another concern, a smart money indicator that had been declining. It did spike up on Friday. We'll see if that's going to change things more positive or if it's going to continue to go down on Monday. And we were declining with the Chaikin oscillator, but now it's ticking back up as well. But we want to keep an eye on this. We use the accumulation distribution, the Chaikin money flow, and the Chaikin oscillator as a group together. And I call those the smart money indicators to try to figure out what is the real smart money doing. And this is a little concerning too. We have the vortex positive, but the green line's declining as the red line's coming up slightly. In a more positive environment, we want the green line to really go up. And we came down a little bit here with the cumulative S&P 500 based on price here and as well as volume, but nothing too drastic, at least yet. And we're still hanging in there with the S&P and comparing it to the NYSE advanced decline line. We're still positive with the S&P 500 new highs minus the new lows, and the 50-period moving average is still going up. This was off the list or off the chart or out of the video, now back on it. We're starting to get extreme again with our 10-day average of the highs and lows for the S&P. That's showing good momentum, and that's longer-term positive. We came down a little bit with the NYSE cumulative advanced decline line based on price, and we really didn't change all that much here with the regular NYSE advanced decline line. Came down just a little bit. So the broader market's holding up fairly well. We break it out based on the common stock on price. It did come down, also declined slightly based on volume for the NYSE. The new highs minus the new lows are still positive for the NYSE, and the 50-period moving average is still going up. So internally, we're still looking pretty good here. And then we look at a 5-period moving average of the highs, lows across the broad market. It's giving us a very high reading right now. We did get another really extreme reading here with this WAG NYSE breadth thrust chart, but this is not an official signal. It did not drop down below 0.4 and then within 10 trading days shoot up above this. So this isn't a signal, but this is positive because we're getting a very high reading here. We look at the ratio between large caps and small caps. Went up a little bit as the large caps held up better than small caps. So we declined, but we're still looking positive across the board here with our advanced decline lines. And we're still looking positive even though we declined those stocks above their 20-period moving averages in the S&P. The 50-period is positive. The 100, after almost becoming extreme, is still positive. And the 200 declined, but is still positive. Short term, not really anything that's put here of note Still looking pretty positive here when we look at all the bars, and you can see the massive spike in volume. The condition of the 20-period moving average. We declined, but we're still above these lines. That means they're still going up. So for right now, the short-term trend is positive, and that remains intact. We're also well above the simple and exponential moving averages based on 20 periods. This blue line crossing above the red line could be positive because it moves faster. We're above all the plotted moving averages here. That's still positive on a trending basis. We're just a little bit extreme here when we measure the distance away from the 20-period moving average. We were far away from the 50, but that fell back down a little bit, and we're still looking more positive on our distance from the 200-day moving average. We came down after looking almost extreme with the 20-period exponential moving average of the S&P. We came down, but we're still extreme with the 50, and we're also still extreme with the 200. And we declined, but we're looking here at extreme positive readings, which could also suggest good momentum for the Stochh RSI, the Williams percent R, the CCI 14, and the CCI 20. We're still extreme with the short-term stochastics, intermediate stochastics, and the long-term stochastics. We declined, but still positive with the force index. And here's the rate of change, a new addition here. Getting above this red line. Now, I put the red line on here, nothing magical about it, but sometimes when we got about to this level, that could mean not necessarily a reversal, but at least an exhaustion. And we're looking okay. We're in the +2 channel with our standard deviations chart. We get concerned if we get up into the +3 channel. That means we're getting overbought at that point. And then intermediate term, we declined, but we're still positive with the balance of power. We declined, but we're still extreme positive with the CMB composite. The condition of the 50-period moving average, we're still above both lines, and both lines are going up. We're still positive with the no-go. Okay, let's try that again. The no-go with the dark blue bars. We're still near the high end here with our highest high value chart. The TTM squeeze, it's ticking up just a little bit, but it just has not been moving as we've been going up here. And we're still looking at a pretty significant standard deviation reading. That measures speed going over the last 10 periods. It's coming down, but it's still above its moving average. And we're slightly positive here with the ease of movement. And the Erin just really kind of dropped off here. Even after the big update on Thursday, this still dropped off. So it's picking up something, but we're not necessarily seeing that confirmed with other charts. And we're declining. Now, this is something we want to watch. The S&P McClellan oscillator is getting close to this point where it might drop negative. So we want to keep an eye on that one. But as long as we're above zero, we still see the summation index based on price going up and volume. We're slowing down here, but we're not rolling over with either one, at least yet. We're declining, but still positive with the NYSE McClellan oscillator. So we're still going up with the summation index based on price and volume. This is also kind of a concern. We're positive with the Swenlin trading oscillator, but we're declining based on price and volume. We already started to decline based on volume. So we're keeping an eye on this one too. But the momentum is still positive. The PMO is positive. We're positive based on price and volume. We're declining, but still positive for the most part here with the PMOs that are rising, rolling over a bit with the buy signals and flattening out at a pretty high reading for the PMOs above zero. We're still positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. Here's our short-term oscillator. We're still positive with the slope, and the MACD is still positive. We're now looking positive across the board in the short, intermediate, and long term with the momentum. And another momentum indicator is cross positive, the Copic curve. We're getting extreme positive here with the Sean trend meter. And the bullish percent index is extreme positive. Now, it's positive on one hand, but when we get around where we're at right now, sometimes this can be at or close to a top before it starts to go down. We're still going up here with the NYSE bullish percent index, and we're right on the border with the NASDAQ 100 bullish percent index here. The money flow is declining, but still above 50. The ultimate oscillator is declining, still above 50. So both of those are still positive. We're declining, but still above an advancing moving average with on-balance volume. We're still above 50 here with the RSI 14 and the RSI 9. This is a warning sign too. We've been going up here with the Ichimoku cloud, but the indicators that it uses, the red line is starting to cross above the blue line, and that's a concern. We would see the blue line above the red line if we were more positive. And we're looking good longer term here. This is a weekly chart of the S&P. We're still well above this R2 pivot level. We're still looking good with the trend here, with the Heiken Ashi being positive. The Kegi charts are positive. The Renko chart is positive, and the three-line break is also positive. So on a trending basis, we're doing okay. It's some internal things that we're concerned about. Long term, we're still looking pretty good, even though we declined slightly with the 150 and 200 period moving averages. We're positive across the board, according to the Keller market model. We're positive in the short term with commodities, but negative in the intermediate and long term. We're negative across the board with the dollar, or stocks and bonds based on price are positive. And we had utilities, staples, and communication was unchanged here. Utilities can be considered to be a defensive area. Staples is definitely a defensive area. And then we saw a lot of the other growth areas show some weakness. And we saw some negative signals that were triggered right as we opened, but then things became a little bit more positive as the day went on. Most of these are just the NASDAQ bouncing above and below round numbers. We're still holding up okay with the S&P weighted index versus the equal weight. Here's another measure of that ratio. We ticked up just a little bit as the weighted version slightly outperformed. Set a new all-time high with the Dow. We're positive with the Elder's Impulse system. With the diamonds, we're still positive here with the NASDAQ, even though we declined 1/3%. I don't know if that'll get picked up or not. I tried to cover the microphone here. Sorry about that sneeze. I'm not going to go back and start recording. We're declining slightly about 1/4% here, but still above the 50-day moving average with the NASDAQ 100. We're still positive with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive, and we're above all the moving averages here with the QQQs. Small caps, of course, they went up, and now they have to go back down over 1%. And we were getting extreme when we look at the Russell 2000 small caps, came down a little bit on the RSI. Still looking okay here, but not breaking out based on price. The momentum is still positive. And the small caps are still positive with the Elder's Impulse system. Mid caps were down, but not breaking out, but not breaking down either. And we're still positive with the Elder's Impulse system for the mid caps, coming off of setting an all-time high here with the Wilshire 5000. Also down 1/4% with the total US stock ETF after setting a new all-time high. And the staples to tech ratio is continuing to decline here, even though it's now in an uptrend. This uptrend is a concern. If we continue to fall, that would be more positive for the tech sector. If we keep going back up, if we turn and go, then that means staples, a defensive area, is outperforming tech, a growth area. And the financial sector was down slightly, but still holding up quite well. The FANG index was also down almost 0.5%, still above its 50-day moving average. We're still below this shorter-term trend line, but we're still above this longer-term trend line with the FANG index. Apple was down 0.29%. We had Amazon up almost 1%. And Microsoft was down 0.78%. Meta, probably the best looking chart here, as I've been saying, breaking out, doing quite well. NVIDIA was down 1.5%, coming down to its 50-day moving average. And Google is still below its 50-day moving average. It was up, but it's above its 200-day moving average. It's a little bit of a concern that we're seeing the 50-day really coming down. Tesla is still dealing with its 50-day moving average. It was down 2.33%. Netflix was down almost 0.5%, but still looking good there. Seeing a little bit of a strengthening with U.S. stocks versus world stocks on a short-term basis. A little bit of a turn up here with the longer-term correlation. Oil is still above 70. We had dropped below 70, and we closed just at 71 on Friday. The dollar continues to be in a downtrend, even though it was up slightly on Friday. So we were down. This shows that we were down a little bit with the 10-year yield, and we were up with just a little bit here with the ETF. This one shows that we were negative. This one shows, okay. It's kind of hard for both of these to be down at the same time since they move in opposite directions. That's why I'm a little bit confused about the 10-year yield. We're still back to being normal again with the 10 to the 2-year yield curve. but we have a ways to go with the 10 to the 3-month yield curve. We're keeping an eye on this. We see that 3-month yield really dropping big time. Is that signaling that there's some kind of a problem? We don't know yet. There's nothing really to suggest that. You can listen to everybody's speculation and a lot of different conclusions. We do things based on what the charts are telling us. And yes, this is a concern to us, but what is the context of why this is falling? It appears that the yield curves are trying to go back to being normal, but there's not really anything on the horizon that's a real concern, at least right now, but that can always change. It was also nothing on the horizon back in 2007 before we went into 2008. And seeing a little bit of a tick up here with Qs to the S&P, discretionary S&P is doing quite well right now. We saw large cap growth outperforming large cap value. So a bit of a tick up with the large caps, mid caps, and a little bit, we're pretty much sideways with the small caps. This is also a concern. We want the S&P to utilities ratio to be going up if we're positive. If it's going down, we are negative. We also want this to be going down, which it is doing right now for the most part, even though it was up a little bit on Friday. This is the Staples to S&P ratio. And here's the Hindenburg-Ullman with the definition of what that means. And we're still working off of a confirmed signal right now. And we'll just see how things play out. Now, the reason we're paying attention to this is the last 2 times we saw confirmations, this was before the COVID crash, and this was right at the end of 2021. So we just want to pay attention to that and see if we see confirmation coming through in our other charts. So what's our outlook? We're still positive. And the smart money indicators, okay, they improved on Friday, but they still have been a concern over the last week or so. We also have a confirmed Hindenburg-Ullman, and we're coming into a time of quite weak seasonality. And the week, and I tried to make a play on words here, a week after options expiration. And I'll show you that here in a minute just with the statistics. We're going to get the S&P Global U.S. Manufacturing and Services PMIs coming out on Monday. And then the geopolitical events going on right now. Just wondering if that's going to have any kind of an impact on the market. So here's the economic calendar for the upcoming week. We're going to get a lot of real estate data. We'll get the Case-Shiller home price. We're also going to get consumer confidence. The new home sales will be coming out. The biggest day will be Thursday and Friday, where we want to keep an eye on jobless claims, durable goods. Now, the third estimate for GDP, we've seen this number 2 times before. So if it comes in about as before, it's a non-event. If there's a big change, that's when it can spook the markets. Also, pending home sales will be coming out. Then we're going to get the big one. Personal income and spending, PCE prices, and core PCE will be coming out on Friday. And this just highlights what's happening and some of the forecasts in the previous readings of the economic reports. Seasonality. This is one of the most negative days we see all year for September 23rd. Now, first, going up here, we're only up 30% of the time, but that means we are up 30% of the time. So we could always buck the trend. But when you look at the percentages of up versus down, we're down 70% of the time the week after options expiration. But looking at the day itself, Monday is negative, quite negative. And now we're coming into a time historically when we do see some pretty significant seasonality weakness here. But Monday is the most positive day based on 2023. It's also been a fairly positive day here in 2024. This is the weak seasonality that I've been trying to point out here. Also, some weak seasonality in this chart as well. So the warning signs, and I feel like a broken record with this. We do have a confirmed Hindenburg-Ullman, and we're coming into a time of weak seasonality. Doesn't mean these things are going to happen. We just want to be aware of them. We're also watching the staples, utilities, and healthcare. Those are defensive, and we're keeping an eye on energy to see. Mainly utilities is what we're watching, and so you can kind of put these two together. But we're also watching oil because of geopolitical reasons. And growth to value, discretionary to staples, doing okay, but we need to see more follow-through with them. Positive signs. We're looking positive still with our smart money indicators, but other than Friday, we've been seeing some concerns here. And the equity put call ratio, both based on 5 and 10 days, are both going down. Advanced decline lines are still looking good. We're good with the momentum with the oscillators and Copic curve. The S&P and NYSE McClellan oscillators and summation indexes are positive. The Swenlin trading oscillator, it's positive, but it's declining based on price and volume. That's a concern to us. The parabolic SAR, and we're looking extreme with the S&P and NASDAQ 100 bullish percent indexes, but the NYSE bullish percent index is still just plain positive. The vortex is positive, but not really going up the way we would like. The money flow is positive, ease of movement, the ultimate oscillator. These are secondary oscillators that I look at, and they're still looking okay. And the momentum for the NASDAQ 100 is measured by the PPO is positive, and the financial sector is positive. So our conclusion, we're positive, but we have this confirmed Hindenburg-Ullman and weak seasonality. We're just keeping an eye on the smart money indicators. In the short term, that's really what we're focusing on, are the smart money indicators, to see if we can still remain positive there. We're also positive in the intermediate term, but we have the Hindenburg-Ullman and weak seasonality. We're still pretty much just flat out positive in the long term. Thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.